Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Gabriel Ng, Managing Director at Newberger Burman's private equity team. He's going to talk to us today about the current state of the private equity market. Hi Gabriel, thanks for joining us.
Thanks for having me.
Great.
Very, very nice to be here.
Yes, thank you. Likewise. Private equity has had to adapt quickly to a higher rate, more complex macro environment. So how would you characterise the current state of the private equity market globally, and what themes are currently shaping your outlook?
Starting first with fundraising, we can all recognize that fundraising has been very challenging over the last 2 to 3 years. Right, total fundraising by private equity funds has declined since the peak levels of 2021. Managers are taking a lot of a longer time to raise their funds, and many of them have unfortunately not been able to reach their targeted fund sizes. Right, we also see a bifurcation in terms of fundraising. So a lot of the established, proven GPs have managed to raise their funds successfully, but some of the more emerging GPs have found it difficult, right, to raise their funds. Amidst all of that, we're seeing some opportunities as well. I mean, from our perspective, we have a very large, stable portfolio of GPs globally, and we continue to back GPs that we've been partners with for a very long time, who have been proven in their respective strategies and markets. At the same time, we're seeing an emergence of funded primary opportunities, right? This is us evaluating a fund just prior to its final close, where it's really started to invest. Right, so there is some visibility into the portfolio, right, mitigating some of that blind pool risk. So we're also actively looking at funded primary opportunities in today's market. Second of all, talking about investment activity and deal making, right? Similarly, that has come down from 2021 peak levels. We did see an uptick in the second half of last year, right? If we sort of looked at the data on a quarterly basis, it was actually ticking up in Q3 and Q4 of 2024. That positive momentum has actually continued into Q1 of this year until the news around the tariffs came out. So we did see some of the pullback in the second quarter. But the key message is, I think sponsors and GPs are definitely a lot more cautious, right? The underwriting standard has been elevated. I would say that from our observation, high quality companies continue to trade, right? They continue to transact. So that's what we're seeing on the deal front. Right, we think that deal activity might come back in the second half of this year, but obviously it's dependent on several other factors within the global landscape as well. And thirdly, talk a bit about exit activity, because that's also a key focal point for many investors in private equity. And the exit environment has been challenging, right? A combination of a higher rates environment, a bid-ask spread between buyers and sellers, and just general geopolitical uncertainty has indeed, limited the exits via IPO or, via sale to strategics or other sponsors, right? But within this challenging liquidity environment, right, we also do see some opportunities, right? As a provider of liquidity solutions in an illiquid environment, I think that, gives us the opportunity to uncover some of these investment ideas, right, on the co-investment side and on the secondary side as well. So I would say that, it's been a, challenging couple of years. But amidst a more difficult environment, we're still seeing good opportunities amid dislocation.
Let's get down into more detail about those themes
Sure.
that you mentioned. So you already mentioned, obviously, that the first quarter of 2025 looked really strong for private equity, but tariff-driven volatility quickly derailed momentum in the second. So how are you seeing GPs adjust their deal-making strategies in light of this new geopolitical uncertainty?
With regards to tariffs, I think maybe taking a step back, we did a study as well several months ago, and our findings indicate that private equity as an asset class generally has, greater exposure to services type businesses vis-a-vis public markets. So we believe as an asset class, private equity is, more, I would say, inclined towards investing into these services-oriented businesses, which might see less of that first-order impact, right, from tariffs, right? I don't think anyone is spared from the second-order impact, but at least from a direct impact perspective, PE as an asset class seems quite well positioned, right? And consequently, right, with the announcement of the tariffs, I think it's certainly, given GPs a lot more caution. Deals become a little harder to underwrite in the current market environment. But I think, private equity sponsors that continue to focus on services-oriented businesses still continue to, do the deals and to execute on them. So yeah, so I think a tilt towards sectors such as healthcare, education, business services, technology. I think these sectors, I would say, seeing more deal activity in a more sort of uncertain tariff world. So that's the key observations that we've seen on our side.
Okay, so rates could settle at a high point compared to yesteryear. So, how are you approaching investment selection in this new environment?
Sure. I would say that, the key point to make is that, within the, private equity buyout type investments that we, that we undertake and invest into, we haven't actually changed our return expectations, right, or target return. I think where we've adjusted is really the underwriting, right, and what is the composition of these returns in a higher rate environment. So I would give you some examples, right? I think the dependence on low-cost financial leverage, as well as multiple expansion, feature a lot less in our underwriting today, right? So our underwriting and how we get to that, private equity returns, it's really driven by organic growth, right? Both at the revenue level, right? So top line organic growth, as well as EBITDA margin expansion, right? So back to good old fundamentals, right? Of really rolling up the sleeves and getting the value creation done and improving the earnings of the company. And the additional aspect as well from, in terms of return generation, which would be the case of accretive bolt-on M&A, right? So, having some of these larger platform companies buy the smaller competitors at accretive multiples, right? That's another, area of value creation as well. So I would say that, we haven't changed our return targets, but how we get there is a little different from how, we might have got there in the last 10, 12 years in a low rates environment.
We mentioned the exit environment being challenging in recent years. Can you shed some more light on this dynamic?
Sure. I think if we do a bit of a deeper dive into some of the exit trends, I would say, just call out two numbers, right? I think if we look at private equity exits as a percentage of private equity NAVs, right, we're actually tracking below long-term average, right? So indeed, distributions have been challenged, right? So that is a trend that we observe over the last few years. Another interesting metric to look at is the holding period of private equity investments, right? So based on some of our research that we've done, about 58% of private equity companies have been held for 4 years or more, right? So there is, the key message is that there is a need, right, for exits, but at the same time, the exit environment has been challenged and IPO markets have been subdued. Where we're seeing opportunity in all of this is really in two areas. Number one, it would be co-investments, right? So in a more challenging exit environment, we're seeing transactions such as partial recaps, right? Where private equity sponsors would, sell a small minority stake in some of their portfolio companies to generate distributions, right? And we're seeing opportunities for us to create win-win situations with our GPs and at the same time get exposure to some of these very high quality companies that we've had the benefit of tracking for a while. So these partial recaps have been quite a prevalent theme, right, in the last couple of years. We also see some fund-to-fund transactions happening, right? So GP selling an asset from Fund 6 to Fund 8, right, because they're very familiar with the asset. However, Fund 6 could be at the end of its fund life and need a solution for some of its top performing assets. So we're active participants in pricing the deal that allows the transaction to happen between Fund 6 to Fund 8. So some of these fund-to-fund transactions we've also observed quite a bit more in today's market environment. So we see ample opportunities on the co-investment side, which is why at Newberger our deal flow has actually moved in the opposite direction to the market, right? So we've actually seen an uptick in deal flow over the last few years, and it's us really trying to create some of these opportunities alongside our GP partners. And then now switching gears to secondaries, right? Because that's in a liquidity challenged environment. That asset class has also seen a lot of activity, right? So on, you can further break it down into two different pieces, right? On the LP portfolio side of things, large LPs, might need to, exit or sell their portfolio of, some portfolio of their private equity holdings, right? To, manage their internal holdings or to generate distribution. So we see opportunities, right, on the LP secondary side of the market. And importantly, on the GPled side, we see a lot of GPs thinking about GPled solutions for their top performing assets in the fund as well, right? So rather than selling some of these assets into a suboptimal exit environment, they want to continue to hold these assets on for longer, right? So they look for secondary investors like ourselves to capitalize a new continuation fund, cashing out the older LPs, right? And basically partnering with them for the next 4 to 5 years within these continuation fund transactions, and they can take various shapes and forms, right? Some of these are single assets, some of these are multi-asset continuation funds, but we're active participants in both types of deals. We believe that there is an opportunity to continue to compound, particularly on these top-performing assets. So it's come a long way, right? If you look back 10 years ago, a lot of these continuation funds were really centered around assets that couldn't be exited or not really well-performing companies. But today, it's really centered around the crown jewels of the top-performing assets of the GPs that they believe that it's just continued good runway to generate returns.
GP-led secondaries are accounting for a larger proportion of the global secondary volume. What do you look for in these transactions, and what's important?
I think we really take a fulsome 360 due diligence approach, right? But maybe to take a step back, I think just to give you a sense of how large that asset class is today. Right, last year's 2024, right, total secondary transaction volume globally was about 150 billion, right, and GP-leds actually accounted for half of that, right, so between 75 to 80 billion. So very much an active part of the market, right? But at the same time, for us at Neuberger, I think we have a very high bar as well when it comes to GP-led transactions, because I think there are many factors to consider. I think number one, because of our bias towards quality, right? The underlying asset or the underlying pool of assets have to be, market leading, I would say defensive, profitable, high quality companies that we like to continue to get exposure to. That's point number one, right? They need to be operating in industries or sectors that are defensive and less cyclical. So we'll need to like that, overall industry secular tailwind. I think we also spend a lot of time evaluating the GP, right? What they've done with the asset and what's the go forward plan, right? And also their capabilities within that particular, sector or with that particular investment. And last but not least, I think a very important point is alignment, right? So besides liking the industry, the asset, and the GP, I think with these GP-led transactions, alignment is super important, which is why at Newberger we focus on leading these deals, right? So we're almost never a syndicate participant, right? We want to set the terms, set the pricing, set the structure. And there are a few, important areas that we look at, right, in terms of alignment. I think number one, it's really the skin in the game that the GP has in the continuation fund. So aspects like, percentage, how much of the crystallized carry, right, it's rolled over. I think that's a very important aspect that we focus on. How the fees are structured for the continuation fund, as well as how the carry is structured, right? So many a times the carry is tiered, right? So all these are important aspects to ensure that the alignment is strong and we create, a good outcome for, both the GPs and ourselves in these CV transactions.
Okay. So how is Newberger Burman positioning itself to stand out in such a crowded environment?
Yeah, I would say it's really on the back of a very comprehensive ecosystem that we've built over the last 35 years in private markets. So today we're managing just north of 140 billion within private markets. And I would say that we have many solutions that basically provide, that sort of a value-added, ideas to our GPs, right? So we're not just a pure play, secondary investor, right? We have a large primary program that continues to back GPs across the world. So I think, that primary advantage has really given us that top of mind, right? When GPs think about, such GP-led transactions, because we're not just going in for the transaction itself, right? There are other pools of capital within our platform that could continually or potentially partner with the GP beyond the transaction that is a continuation fund, right? So there's that longevity, the potential longevity in the relationship, right? We have large pools of co-investment capital that can also partner with the GP in other deals, right, that they choose to pursue. And of course, our secondary platform is very established. So I would say that really, operating as a value-added partner has given us a very strong positioning and mindshare with our GP partners. So that's, how we, I would say stand out and, differentiate amidst a more, competitive environment.
Okay, so finally, you have an Evergreen Fund in Australia. Tell us what you're looking to bring investors in that strategy.
Sure. I think first and foremost, we're looking for a structure that I would say mitigates a lot of the restrictions or constraints that have prevented individual investors from accessing the private equity asset class, right? But the way that we've designed our portfolio construction and what we seek to bring to investors, it's also quite differentiated. So from a portfolio construction perspective, our Evergreen Fund, or semi-liquid fund, is very much focused on co-investments. So the vast majority of the capital deployed will be into direct co-investments alongside our top GPs in sectors where they have strong expertise in, as well as complemented by some GP-led secondaries. So we believe that what we want to do is create a very targeted, high-quality portfolio. So we're not seeking to have thousands of underlying positions. We want to make this a very highly curated, right, pool of direct investment assets that we can give investors exposure to. And with a single ticket, they access our global networks and a vast range of GPs, right, that we invest alongside with. So it's not just one single GP, but it's a multi-manager strategy that an investor can get access to across small, mid, large cap sponsors and their investments, right? I would say that it's meant to be user-friendly, right? We have monthly subscriptions and redemptions, right? So, and a single capital call. So we hope that from a investment perspective, as well as from a structural perspective, this would resonate with the investors here in Australia.
Yeah, brilliant. Thanks, Gabriel, for sitting down with Livewire today and sharing your insights.
Absolutely. It's a pleasure to be here. Thanks for your time, Anna.
Great, thank you.
Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.